All right, stocks continue to kind of grind their way lower, showing a bearish bias, but not kind of falling apart. So that's a good sign, the fact that we're not falling apart there. But this grind lower has been gradually moving more and more indicators to the downside. So I'm going to break that down in today's video, kind of show you my expectations for the markets, this intermediate move I believe that we're just starting, and we'll talk about why. We'll talk about what we need to see for that to be wrong, right? For the markets to bounce and move higher. What do we need to see in the short term to reverse these expectations? But we're going to take a look at what's driving a lot of this weakness. Big shift in some major asset classes and Fed rate hike odds really up to high levels. So that's having an impact on equities and risk appetite. So we're going to talk about that. Some of the bigger sector moves. And then we'll take a look at our trade idea of the day. It's a big bellwether. It's a big company, kind of a proxy for the entire market. And it gave a pretty decent signal today. And we'll talk about how to trade that signal. So let's go ahead and get started. Today is Wednesday, March the 1st, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the bottom or the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching here on our blog, check out some of these things on the right, including our Market Outlook live video here. Come down to the bottom, click this heart. It opens up this tab, hit that like button. Same thing here, click the thumbs up icon. It opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to people, out to more and more people, especially to all of our followers on those platforms. So thank you all for everybody who does that day after day. And for those who don't, you can do that right now while you're watching. All right, let's go ahead and get started. Take a look at the S&P 500 with the market forecast indicator. You can see we continue lower. We still have dark pink shading and a red line, which means, again, that we're below 50 and falling on the intermediate line. Still above 20. Still not in the reversal zone, but you are below the market sentiment, which is also falling. And then you can see that we are the moving average. We're below a falling moving average. That's what makes it red. In fact, we're 2.5% below. Remember, that's the cusp. That's kind of the make or break area. That once you get below 2.5%, of course, nothing's a guarantee, but once you get below 2.5%, that typically means that we're on an intermediate run at that point. You can see the last intermediate run got below the 2.5%. Kind of stayed there during the Christmas holidays before rallying back up. So, obviously, the weakest intermediate run of the past year are the other three. You can't see the other one here anymore. We have to go to 2-year charts now to see the peak. But you can see the 1, 2, 3 intermediate runs there that all got easily below 2.5%. And then the weakest one of the year is this one. And then now the question is, what kind of intermediate run are we going to have right now? Until we break the 2.5% mark, we don't expect it'll be too big. We are continuing lower. It's like how many days in a row now? In fact, if you look at, like, we had 1, 2, 3, 4, 5, 6, 7 down days in a row, but 1, 2, 3, 4, 5, 6, 7, 8 out of 9 days where we finished lower than where we opened. That comes after this enormous streak of finishing higher than the open for quite a while, going into that February 2nd peak. But of course, since that February 2nd peak, you can see yields. Here's yields on February 2nd. Over right here, there's the yields on February 2nd. Yields were at 3.39%. Now we're at 3.99%, and that's obviously had its impact on the S&P 500, moving lower and into a intermediate decline. Let's take a look at the NASDAQ 100. You can see we don't have the dark pink shading and a red line yet. We are barely below, less than 2% below the 30-day moving average. So we're not down long enough and far enough yet to turn it down and turn it red. So we're still in the infancy stages of this decline there. We never did get above the 78th percentile. We got close. We never did get above. Remember, the S&P did get above it barely. And the Dow got way above it. You'll see here in a second. But the NASDAQ got above the 62 and failed, and now is working its way down to the 38% retracement level. Here's the Dow. Taking a look at the Dow Jones, which has been more bearish here during this decline. Actually was flirting with the cluster today. Because we finished off of the lows, we finished without a cluster, just barely, 23.4 on the momentum line. So, but for a good chunk of the day, we had an oversold cluster on the Dow. So it's obviously been a lot more bearish. We are more than 2.5%, we're almost 3%. We are below these lows, the mid-January, the pre-expiration lows. And really, for that matter, we're flirting with the December lows. And keep in mind, the S&P is not below those January expiration lows, which would be right here, and definitely not below the December lows. So the Dow had been more bullish previously. I got a cluster a lot earlier than February the 2nd, 2 months earlier. But since then, it's been sideways and it's been a lot more bearish here lately. And you can see its intermediate line is in the reversal zone. Its market sentiment line is about to cross below 50. So that's how bearish the Dow is, again, relative to its peers. Continues to be the most bearish. We've been hedged against the Dow. That's been our pick to be the weakest index over the last little bit. And the idea being that it had such a poor margin of safety because it rallied up so much. Here's the Russell. It also got above the 78th percentile of this last intermediate decline right there. Relative fake out there. We're back at the 62 and still holding some resistance. Intermediate line is crossed below market sentiment, but still not in bearish territory yet. So you still don't have dark pink shading in a red line. We're less than 1% below the 30 days. So we need to break below these lows of these bull tags if we're really going to make a run to the downside. Otherwise, if we're going to reverse, if these bull tags are going to lead to strong bullish moves, then we need to get above the high of this first bull tag, which we're also not anywhere close to either. In fact, you're more than likely going to break below these lows than you are, because we're sitting on the lows, than we are breaking above those highs. Let's take a look at the weekly chart for the S&P. So again, as we mentioned on Monday, we're in a death cross environment. We got the red arrow last week. We're easily below on the Hakinyashi close, mind you, which is the average of this week's high-low open and close on the S&P. The Hakinyashi close has closed below the 10 and 40-week moving averages, and the 10-week is crossing below the 40-week. So we are turning negative. It's a lower close. We don't have that much of a lower low. It's just a slight lower low there, but it is a lower close, and you can see the Hakinyashi differential here. If I were to zoom out, you can see a little bit better. This is where the candle's at, so you can see kind of where the purple line's at here relative to where it's where it's been. So we can get a lot more bearish. We're just kind of starting here. In fact, when you look at the weekly hull, so the daily hull, we're breaking below the 200-day moving hull, the 200-day hull moving average. Obviously, the 20 days been bearish. We are moving lower. We're coming from a higher high point than the last peak. But as of right now, it's a higher low point. But the MACD is still falling, and the stochastic, below its moving average. And we'll see what happens with this, the Hakinyashi differential on the daily chart. But on the weekly haul, we just barely popped the parabolic SAR up to the upside. So we may just barely be starting a bearish decline here. Especially with the MACD crossing below its moving average. And like I said, we're just barely starting this move to the downside on the Hakinyashi differential, which means we're just getting bearish. Looking at the 3 green arrow charts, you can see we have 3 red arrows across the board. So we have pink shading for 4 days in the Qs, for 1, 2, 3, 4, 5, 6, 7, 8, 9 days in the Dow. So that's been the longest one. But everything is pink shaped. So we are on an intermediate decline. That's pretty obvious here. You avoid the intermediate declines with only like a day or two of either white shading or pink shading, and then you bounce right back up. Well, that hasn't been the case yet so far. We haven't bounced right back up. We haven't broken down hard either, but you can see we are in bearish territories, like relative to the 4-week range. We are extreme lows. That typically starts a bearish run when you get to extreme lows. So here we are, over here got to extreme lows, and then we started the intermediate decline here. Let me zoom out to the 2 years. So here's the extreme lows there. Here's the extreme lows here, and that started this intermediate decline. Here's the extreme lows there, and then again here, and then now our first one here of getting below to extreme lows. So again, basically closing near the lows. In fact, If you look at the 4-week range here, we did close pretty much right near the low point of the. We got the low 4-week low this week, which means your red line here, which is the 4-week low point, is on at 100 because we got it today, and your green line is almost at 0, which means your 4-week high point's almost over here, and it will be like it will pop back up, like it will get to 0, and then it will drop down to that high point, and then it will drop down to here, and then to here. So the high point, the range is actually really small. Like that's a small level. If you follow my cursor to the left, that's that when it gets this small, the range, the 4-week range, it typically sets up a breakout move, right? Kind of a squeeze type pattern. Obviously, you would expect with the red line breaking out that you would expect that breakout move would be to the downside. So you're well below the point of control. In fact, we're below the value area in the 4 weeks. So we are in the bearish mode, closing right on the 4-week low point. We are below the green and blue lines still, enough that the green line's now below the blue, and we have a 26-day rate of change, or a negative 26-day rate of change. That's what that red line is. It's a visualization of this chart right here, this index. It's a 26-day rate of change. You can see it's gone negative now. Again, it goes negative when you start bearish declines, even the small ones. So it is now negative, and you can see that visualized here as well. It's below, like the red line, which is today's close, is below where we closed 26 days ago. So we have a negative. But you notice we haven't even started a bearish trend yet. The trend noise balance is still below 50. We're not even below -1 yet to get any kind of weak trend going, which you can see you have to get. We never did get. We were just a weak trend. That was it. We barely got below -1. We barely got above 50. I mean, it's about as weak of a trend as you could get, whereas these others were a little bit stronger. So again, we may just be starting here. Looking at the DMI, you can see we did cross back above 25. In fact, this is barely the highest level for the negative indicator since we've started this bullish run. The negative indicator dropped back, positive indicator, dropped back down, but they're so close to each other. The ADX, again, is really low. If you follow this line across, again, when it gets this low, it typically leads to a breakout move. In this case, it was a breakout move to the downside as the negative popped up, positive dropped. Over here, it was a breakout move to the upside. The positive line rallied, the negative line dropped. And then over here, you can see it was also a breakout move to the upside. There, positive move up. And this one was also a breakout move to the upside. So here we are, again, which way we're going to move. And the guess would be that we'd be breaking out to the downside because that's where we already are leaning in that direction. But we are set up for that kind of move. The Bollinger Bands are coming off of their lows, which are near their 150-day lows, and they're contracting. So you can see we've been gradually contracting here on the bandwidth. We are in the lowest quartile, which again would suggest that we're probably going to get the breakout to the downside. The bands we've been in the lowest quartile enough that the bands have pushed outside the Keltner channels. We did not break out of the lowest band unless we get a really significant drop, which is obviously looking unlikely. We're more than likely not going to break out of that lower band, but we can break out of that lower Keltner channel. So kind of watch for any declines. As their gap gets bigger between these two, you can start to trade inside. Now, we didn't there because it was weak. That was a weak decline, but if you go back to the other 3 declines over the past year, intermediate declines, we did trade. You can see we did trade in between on that one. That started it all. We did trade here in between on the April one, coming off of that March fake out peak, and then of course over here during the August one, coming off the August fake out peak, we moved. So those moves, and we didn't on August. We didn't break below lower band, similar to what we're seeing so far right now. Essentially, because we were just like in August, we were pretty bullish, and we transitioned from being pretty bullish with a fake out move to being pretty bearish, and that's kind of what we're doing again right now with the green dots and the increasing negative momentum down there. And that momentum is relatively low. If you look at where if I put my cursor, if you look at where all the other intermediate, where the bearish momentum got to, they got to relatively low levels in each of the other 3 runs. And for the 2 off the March and August fake out peaks, they lasted quite a while. There was lots of red and yellow there and lots of green dots. So they were relatively longer bearish declines, the kind of move you expect. And we're probably going to get this go around. The RSI and CCI show up bearish levels. The RSI is not broken below 40. It didn't break below 40 on this one, and we rallied. So we need to break below 40 like we did on these others for this to turn from green to red. We are in bearish levels, but we can bounce off of this level and really move up higher. Get above this. This was the bull tag in the market forecast. We get above this high point, then we're bullish, right? Then we're rallying to the upside. Obviously, since we're well off of that high and unlikely to get there, the likelihood of that happening is lower, or more than likely at a tipping point where we're going to get a significant move one way or the other that in this case to the downside, that breaks us out with a significant move to lower, probably some kind of breakaway gap below the 3,800 level, 3,900. If you look at where some support is right now, you can see there's not a lot of support until you get down to 3,800. So we can move in that direction for quite a bit. I mean, that's more than 100 points down, 150 some odd points to the downside before we approach a real significant support level on a Fibonacci basis. So we can move lower and fill in that gap there. You can see it as well on the two-line version of this chart. It's that 200-day moving average. We've been trading inside the gap between the 15 to 200, centered right on the point of control. Full control, for the past year. Well, if we break that 200, again, you can see how easy it will be to get, because there's no other support and there's no volume until you get down to this 380 level. At which case, that's when things can pick it up and we can approach those October lows again. Let's take a look at the VIX. Here's the other thing, too, that's kind of standing out. The VIX is not rallying. We've been dropping since February the 2nd. February the 2nd is right here. So we've been rallying. The VIX, that's when the VIX hit its lowest point. We're up, but we've been dropping the last few days. Really since last Monday, we've been dropping on the, it'd be 221. Yeah, 220. 221 we gapped up coming off of the holiday. So that'd be Tuesday. And then we've been dropping ever since. The VIX has been to the point where the correlation of the VVIX and the VIX have moved, is moving down to levels that you expect the VIX move to rally, right? The VIX are rallying. We've been dropping. We rallied. We kind of broke out. We pulled back, and now the expectation is, we'll bounce off support here and work our way up and close above 100% at some point in time. The VVIX would suggest that that's the kind of move that's coming. The VVIX has really dropped down to really, really low levels, and again, suggesting that again, the pop on the VVIX correlated with the VIX, typically very strongly correlated with the VIX, will pop both indexes up, and would be and especially again, as I mentioned to you before, during the seasonally bullish time for the VIX. You can see it's been, even if I go back to the 20-year, we typically hit a low point here right around February expiration. We did, and since then we've been rallying up to the upside. A little bit of a pullback right now, but we have until March 16th that we typically peak before we really start to pull back going into the end of April. The month of April is a really negative month for volatility. Just like over here, you can see from the month of July is also a really negative month for volatility. But March is a really bullish month, so we need to kind of watch to see what, at least the first half of March. That's where we ended up peaking on average about 20% above, and we're still 10% below zero. So I believe we're still due a move higher off of this higher low point on the VIX. In fact, when you look at the, where we are here relative to its average values, we pulled back down to some of its average values, not getting below this low point, below, or right around the 17-day, and still, again, with the possibility we can bounce back up. All right, now let's take a look at what's driving the price action. You can see over the past 3 months, equities have been down generally speaking, except for developed market equities, which are still outpacing the rest of the crowd. Commodities have been down, but gold's been up with the weakness in the dollar, and then yields, of course, have been up, especially since February the 2nd, right? When you go, after we peaked on February the 2nd, from February the 3rd on, you can see that it's been a strong dollar move, and yield, long-term bonds are down 7%. So they're actually have fallen more, than emerging market stocks and the Qs. And then real estate's down nearly 10% in that same time frame. So a lot of a lot of movement in the wrong direction for a lot of these typically risk asset classes, except for, of course, long-term bonds you wouldn't consider. But we're in an inflationary environment, so bonds and stocks tend to move together in an inflationary environment. And that's what happens. That's what's going on right now. Commodities, reflecting the inflationary environment, are outpacing pretty much all equities and treasuries and bonds, corporate bonds, high yield bonds, and treasuries, as well as global bonds. Of course, it's just down against the dollar, so they're just right there at zero. But again, relative to everything else, looking pretty strong. Looking at just today alone. So emerging markets had a great. China was up big early this morning. They held their ground all day long. Commodity prices rallied throughout the day. Again, not the best scenario. Long-term bonds were down all day long. That's not the best scenario. The dollar was not bullish though. So it's been commodities and long-term bonds and the dollar that's been the three-headed monster that's weighed on risk appetite. But the dollar was down today. And of course, it's down because it's been by far the most bullish over the past few weeks. But you can see that high yield bonds were down, not outpacing treasuries, but they were down. In fact, when you look at the ratio chart here, let me pull this up here, high yield of corporate bonds to treasuries, you can see we are back down below the 8 and 17-day moving averages. Back below the 50-day we have been for a while on LQD relative to IEF. Of course, well below the 30. Long-term PPO between the 50 and the 200 is starting to roll over, so we're going to start filling in that. You would expect it would fill in the gap. Again, that's risk off. You see the same situation developing in the kind of smaller duration with high yield. We are still well above moving averages, but again, you can see off of that February 2nd peak. A little bit more bullish in the past week, setting up for more bearishness to come. At least that's my expectation here. We'll see. If we can cross through to new highs, the problem is if you look at how high we actually are, we are actually pretty high. Like, again, according to this spread, we are at the most risk, the highest, strongest risk appetite levels since coming off the COVID peak. So obviously we know that's not the case, but that's how strong high yield is relative to its equivalent treasury duration. Whereas again, if I were to look at the longer term LQD relative to IEF instead, we're not near those highs. Those highs were at the end of 2021, and we've been down. But again, high yield relative to IEI, it's a little different story. So we've been a little bit more bullish. We're at resistance. We're at these peaks that led to a pretty bearish move before, and we'll see if it ends up leading, especially considering how strong the long-term PPO is between the 50 and 200 day. Probably a little bit too strong considering the environment that we're in right now. It's not necessarily the most risk-on environment. Let's take a look at the sector moves and how they've performed. So let's come over here to the sector comparison chart, and let's go to just today. You can see energy was up 2%, materials up as well, industrial, so kind of a weak dollar move. These are all kind of economic growth sensitive areas in the U.S. stock market. On the other hand, utilities and real estate were down at the lowest levels. Again, that's kind of a reflection of yields, right? Yields were up today, and that's putting pressure on these risk assets. If you look at like the TNX, it was up to 4%. It's flirting on breaking above 4%. And working its way back up to August peaks where we were above 4%, and you can see how bullish that is. In fact, on the weekly version of this chart, you can see how strong the the daily is, but in the weekly we're just getting going, and we're back above and have been above this entire time, bouncing up to 30-week and back above the 8 and 17 and rising. So we have an opportunity to be relatively bullish. You can see there's also a little bit of a head and shoulders pattern if we do peak out here. But as I saw somebody on Twitter say, the next time we hit 3.5% on this, or was it 3%? Either 3 or 3.5%. The next time we hit 3.5% on the 10-year yield, it's not going to be a bullish. It's going to be bearish for equities, because that means the Fed will be lowering interest rates. So you can see since we peaked here on February the 2nd, here, let me go to historical. You can see that as of right now, the June odds to be at 5.5% are 80%, because we're at 20 below that. So we're at 80% odds that we will be at 5.5% by June. That's a 25, 25, 25, or 50, 25, 0, whatever. But 3 more 25 basis points, 75 more basis points. A month ago, those odds were at 2.1%. Now they're at 80. In fact, if you go to the historical chart here, you can see, again, this is at 80% now, just a little bit higher than where this is at, 80%, right on that line. So today it's a little bit higher. I mean, just as of February the 2nd, the odds were 1.94%. So the day that we had the exhaustion gap on the S&P, since that day, the odds to be at 5.5%. The odds to be at 5.25% were below 40% then. Now they're near 100. Pretty much 100 now, and being at 5.5 is there. And then you look at where we're expected to be. Here's 5.5%. We're above 60% odds. In fact, we're at 75% odds now of being at today. So it moved up even more today. But we're at 75% odds that we're going to be at 5.5% at the end of the year. Again, on February the 2nd, that was a point. It was 0.138, 142. 1.42%, no, 0.05% that we were going to be at 5.5% at the end of the year. We were only at 1.37, 1.42% odds of being at 5.25 or higher, and now that's pretty much at 100. In fact, when you look at it over here, you can see how far up above 80 we are. But if you look at it over here, being at 5.25%, it's pretty much, 94% odds now. So things have shifted dramatically, and of course, a lot of that has to do with yields moving higher, and there's still a long ways to go for something to happen here, right? So you can see that's the other spread. Here's the 10-year, now a little bit over 4%, but there's still a long ways to go. You can see the move on yields over the past year, but just zooming in from February the 2nd, here is February the 2nd right there. So from February the 2nd on, we went from 3.3% all the way up. And that's been reflected in higher rate hike odds. But the issue is, you can see back over here. Sorry, let's try this one more time. Okay, so on February the 2nd, or even February the 1st here, the spread was only at 70 basis points, 69. Now we're at 89. So the spread has gotten worse instead of better. The spread has got, so again, it's not a bad thing for the spread to go down. It's a really bad thing for the spread to go up, because once we start to uninvert, then something is giving, and either we're really rising on the 10-year relative to the 2, which is inflation expectations, or we are rising, or the Fed is cutting rates, which again, the Fed will only cut rates, especially considering the real Fed funds rate is still pretty negative. The Fed has not, the last time the Fed stopped raising rates before the real Fed funds rate got positive was way back over here in the 70s, right there in the late 70s. It was in the 75, 76 era, the famous 75, 76 era that Arthur Burns, you can see he stopped raising rates and stopped one little drop, but pretty much stopped raising rates in July of 1974. Well, if you go back to where the real Fed funds rate was in July 1974, I guess it was just slightly positive there, and they stopped raising rates at that point. And you can see another little hike cycle here in 75, at the very tail end of 75, a little move higher, and then you can see the jump back up in 77, right? So those cycles occurred right here in 77, and then late 75, right in this area. So those are the last times the Fed raised rates and then stopped before we got to a positive real Fed funds rate. You can see we're still way off having a positive real Fed funds rate. We're still at minus 200 basis points, which going into this year was a relatively low level, right? You can see 200 basis points is right in this area. I guess it'd be right about right there. That's 200 basis points. So, again, we only get below that on a real basis during these recession levels and during this credit crisis. We were in the credit crisis there And of course now the crisis that we've been in, this inflationary crisis, dropping further. I mean, that was the biggest low point that we've had on the real Fed funds rate, way bigger than what we saw in the 70s when the Fed was when inflation was just out of control, and the Fed started to cut rates here in 1975. Briefly, right? Just a small amount of rate cuts. All right, let's take a look at our trade idea of the day and transition into that. And you can see I want to take a look at Apple. So Apple's kind of a proxy for the broader market. It got a bull tag today. It's the first bull tag. See, it did not get a bull tag over here like the S&P did. This is the first bull tag here today. The question is, again, is it a bull tag that will start a bearish run or a bull tag that will start a bullish move to the upside? Right, well, my expectation is it's going to be the former rather than the latter, as already have been moving lower. In fact, when you look at the MACD and the stochastics on the 2-line versions, you can see the 8 days crossing below the 17. Like, we've been below the 17-day moving average. The MACD's been below its moving average for a long time. And we finally started this divergent move, and then now breaking below the 30 and the 200 at the same time, with the falling MACD and the bearish stochastic and getting below the point of control. You can kind of see that we are starting to work our way towards a little bit of a decline. Here's Apple on the weekly chart. And you can see too, again, on a weekly basis, getting towards the, getting back below the 50 and the 30-week moving averages and looking like it potentially could cross back below the 17-week. So again, hence why I think we are more in the former camp of starting a bearish move than we are starting a bullish move. You can see some other factors here. The stochastics on the 4-week range breaking well into bearish territory. So already has broken below the midpoint of the chart. 50% now is broken below 40%, is working its way to oversold levels. You can see that on this level too when you look at the Arun indicator. If we pull up Apple here, you can see, let's pull up Apple. There it is finally. So there's Apple. Again, it does not have the 4-week low point, but you can see how close we were. We're only 2 days away. In fact, you can see the high point after hitting 100, we are well below 70. In fact, we're almost to 0. It's not very often that you get both the high and the low down below 10. But it looks like we're going to get that case. And generally, that's especially with the very low range right now, in the 4-week range. You can see how high it can get. Again, it looks like we're setting up for a bearish move to the downside. You can also see too, on the Bollinger Band and Keltner channel basis, the bandwidth is at its 150-day lows. Eventually here, there we go. It's at its 150-day lows. We are crossing towards the lowest quartile. You can see the momentum is turning negative, and the bands are inside. The Keltner channels are setting up for a squeeze play, a move to the downside after being relatively bullish. But then getting that February 2nd move right here, this kind of exhaustion gap. Apple kept going up, the markets didn't. But now we finally have filled in that gap with this move, and now you have the potential of getting more bearish. You can see the momentum here where we're at right now. Again, still with red dots, so we're just kind of starting. But the momentum here, as negative as it is, you can see across the chart that we're just kind of getting going on there. We can get a lot bigger on the negative momentum, and I expect that we will. And that's kind of why I decided to do a bear put spread, long put spread, relatively safer long put spread, selling buying the 140 put for April, selling the 135. So I'm not buying at the money, but just one strike out. If I bought the 135, I'm getting a really good reward to risk ratio. It's pretty speculative, but you're looking at one standard deviation move to get to 130. So this gives me some flexibility. I'm not quite at the one standard deviation move at 130 here. It only has to get below 135. So if it doesn't go up if it goes up a little bit, or if it takes a little bit of time to get going to the downside, that's how much wiggle room I have to work with before the max gain gets outside of the one standard deviation window of opportunity. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between the videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Follow us on Twitter and Facebook, and like our posts there as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.